Welcome to XRP Pro Ledger, and today we need to address something directly before we get into the data, because Brad Garlinghouse just stated publicly at Consensus 2026 that over 30% of Ripple's $13 trillion enterprise treasury pipeline will migrate on-chain over the next 5 years. That single statement contains a mathematical equation that most retail investors do not have the framework to solve. And the output of that equation is a price range between $133 and $270 per token. That is not a prediction, not a community target, and not social media speculation. It is the arithmetic result of applying institutional velocity assumptions to a confirmed enterprise volume figure against XRP's fixed circulating supply. Stay with this analysis until the end, because the velocity drop theory, the specific mechanism by which institutional custody behavior mathematically forces that repricing, is the hidden Wall Street equation that explains exactly why selling at $1.40 right now is not a neutral decision. It is a permanent transfer of supply to the entities that have already solved this equation. Before the velocity mathematics can be understood correctly, the concept of velocity itself requires a precise definition, because retail investors systematically misread the velocity signal and draw the wrong conclusion from it. In monetary economics, velocity refers to the rate at which an asset turns over, how many times the same unit of value is used in transactions within a given period. XRP's current annual velocity is 68x. That means the average XRP token changes hands 68 times per year. Retail investors look at that number and interpret it as a sign of market activity and engagement. High turnover feels like momentum. It feels like the asset is being used. The institutional interpretation is the opposite. A 68x velocity rate in a digital asset market is the signature of retail speculation. Tokens being bought and sold repeatedly for short-term price gains, not held as collateral, not used for settlement, not vaulted as institutional reserves. 68 times annual turnover is fragile, retail-driven, speculative float. It is the exact condition that precedes a structural repricing when institutional custody behavior enters the market. The retail psychological trap operating right now is built on a misreading of low volatility that is the direct inverse of the misreading of high velocity. Retail investors watching XRP trade in a narrow range around $1.40 conclude that the market has lost interest, that the absence of dramatic price movement signals the absence of meaningful activity. The exchange data tells a different story. Whale outflows and dominance have surged past 90% of exchange activity, while retail participation has collapsed below 10%. The market is not quiet because nothing is happening. The market appears quiet at the retail level because the entities currently active in the market are not day trading. They are removing supply. Evernorth, a newly formed Nevada corporation designed explicitly to enable XRP institutional adoption, just expanded its board with Ripple's chief legal officer, Stuart Alderoty, and the former CFO of the OpenAI Foundation. Compliance boards of that caliber are not assembled for speculative positions. They are assembled for long-duration custody programs with regulatory reporting obligations. The velocity drop mathematical framework is the analytical tool that converts Garlinghouse's $13 trillion statement from a headline into a price equation. The framework begins with a basic monetary identity. In any settlement system, the price of the settlement asset multiplied by the circulating supply multiplied by the velocity must equal the transaction volume the system is designed to clear. Applied to XRP, price multiplied by 58 billion tokens multiplied by velocity must equal the institutional transaction volume flowing through XRPL infrastructure. At the current 68x retail velocity, the math balances at today's price because the volume being cleared is retail speculative trading, a fraction of the enterprise volume Garlinghouse has committed to bringing on-chain. When institutional custodians enter and velocity compresses to 20x, a conservative estimate for institutional holding behavior, the equation must rebalance. With supply fixed and volume increasing, the only variable that can adjust is price. At 20x velocity and 30% of $13 trillion in annual enterprise flow, the math produces a required price of $133. The $270 figure emerges from applying the same equation at a 10x velocity assumption, the standard institutional holding rate for assets that function as collateral rather than trading instruments. When institutions use XRP as clearing collateral for DTCC obligations, as Ripple Prime's 300 institutional clients are positioned to do, the tokens are not traded, they are vaulted. A vaulted token has a velocity contribution of 0 for the duration of the vault commitment. The effective market velocity, calculated across all circulating tokens, including both actively traded retail supply and vaulted institutional collateral, compresses dramatically as the institutional custody percentage increases. At 10x effective market velocity, with 30% of a $13 trillion enterprise pipeline flowing through XRPL settlement infrastructure, the price required to clear that volume without generating system-level liquidity fractures is above $270. This is not a ceiling. It is the mathematical floor below which the settlement infrastructure cannot function at the volume Garlinghouse has publicly committed to delivering. Evernorth board expansion provides the operational confirmation that the institutional custody program implied by the velocity math is not theoretical. It is being actively staffed and compliance structured for execution. Stuart Alderoty's appointment to Evernorth's board is significant not merely because of his role as Ripple's chief legal officer, but because of the specific legal expertise his presence signals. Alderoty has spent years navigating the regulatory frameworks that govern digital asset custody, securities classification, and institutional compliance. His presence on Evernorth's board signals that the entity is building a compliance framework designed to operate under the regulatory scrutiny that applies to institutional asset managers, not retail investment vehicles. The former CFO of the OpenAI Foundation brings the financial governance infrastructure that large-scale institutional treasury operations require. These are not advisory appointments. They are operational hires for an entity that is being structured to hold significant XRP supply under the regulatory frameworks that the Clarity Act is about to formalize. The 90% whale dominance figure on exchange order books is the on-chain confirmation that the velocity compression process is already executing ahead of the legislative timeline. When retail participation drops below 10% of exchange activity and whale dominance exceeds 90%, the market structure has already transitioned from retail-driven speculation to institutional accumulation. The tokens being removed from exchange order books by entities operating at 90% of market activity are not being repositioned for short-term trading. They are being transferred to custody infrastructure, cold storage, qualified custodian vaults, and compliance-structured corporate treasury accounts like the one Evernorth is building. Each transfer removes tokens from the tradable float permanently for the duration of the custody commitment, and each removal further compresses the effective velocity of the remaining circulating supply, bringing the equation closer to the price point where the math forces the repricing that the $133 to $270 range describes. Jess Cheng's contribution to the Federal Reserve's FedNow instant payment system is the regulatory infrastructure confirmation that connects Garlinghouse's $13 trillion enterprise pipeline to the specific U.S. payment architecture that will route that volume. FedNow is the Federal Reserve's real-time gross settlement infrastructure, the system that enables instant payment finality for U.S. financial institutions. Cheng's background as former legal counsel at Ripple, combined with her active contribution to FedNow's development, creates a documented personnel bridge between Ripple's XRPL settlement infrastructure and the Federal Reserve's instant payment system. The enterprise use case this enables is precisely the one Garlinghouse has described. Corporations like American Airlines transitioning from 4-day correspondent banking settlement delays to instant cross-border liquidity provisioning using XRP as the central settlement layer. 4-day delays carry float costs, counterparty risk, and operational friction that large corporations absorb as a cost of international commerce. Instant settlement eliminates those costs entirely. The American Airlines use case deserves the analytical attention it warrants because it represents the specific corporate treasury application that converts the $13 trillion enterprise pipeline from an abstract figure into a concrete operational deployment. American Airlines processes international payments across dozens of currency corridors: fuel purchases, aircraft leasing payments, foreign staff compensation, terminal fees, and passenger revenue settlements in local currencies. Each of those payments currently routes through correspondent banking networks with settlement delays, FX conversion costs, and counterparty exposure that American Airlines manages as a cost of its treasury operations. If those payments route through XRPL infrastructure using XRP as the bridge asset, the settlement time compresses from 4 days to 4 seconds. The FX conversion cost approaches 0, and the counterparty exposure is eliminated by the finality of on-chain settlement. The treasury savings for a single airline operating at American scale justify the infrastructure investment independently of any speculative XRP price appreciation. The enterprise adoption is driven by operational cost efficiency, not market sentiment. The complete picture from today's data assembles into a single, coherent institutional deployment sequence that the retail price chart cannot capture. Garlinghouse confirmed $13 trillion in enterprise treasury flows migrating on-chain. The velocity math produces a required price between $133 and $270 as the institutional holding rate compresses effective market turnover from 68x to 10x. Evernorth has assembled a compliance board with Ripple's chief legal officer and the former CFO of the OpenAI Foundation to custody the supply that the math requires to be removed from the float. Whale dominance has already surpassed 90% of exchange activity as the accumulation executes ahead of the Clarity Act markup. Jess Cheng is bridging Ripple's settlement infrastructure to the Federal Reserve's FedNow system, and American Airlines represents the specific corporate treasury use case that converts the enterprise pipeline from a commitment into an operational deployment. The retail investor looking at a $1.40 price chart is looking at the last price that will be set before the velocity equation forces the repricing that the institutional accumulation is positioning for right now. If this analysis changed how you're thinking about XRP, hit like and subscribe. I drop deep dive breakdowns like this twice a day to keep you ahead of the market.